It's really important that you understand the operator that you're working with and the types of properties that they're going after, and just understanding the different types of return profiles for properties. The higher IRR that you have on a given deal doesn't necessarily mean that it carries the same amount of risk as another project. If you're a residential real estate agent earning $200,000 a year and you want to grow your passive income, this show's for you. Learn the secrets other agents use and hear from experts in our field in order to guide you along your journey to investing in assets like apartment communities so that you can turn your commissions into cash flow. I'm Randall McLeod. Let's go, baby. All right. Welcome back to Agents Building Cash Flow. It's great to have you on today. I'm your host, Randall McLeod, and today I'm going to discuss something that's been on my mind for some time about, I guess, the way the market cycle is going and the types of investments that are out there. So for the last few years, from, I guess, 2018, 19, 20, you could buy a property and you would win just by buying it. Appreciation was there. You could fall over into a great return simply by buying a property, right? Now things have shifted quite a bit. On those deals in recent memory, you could buy them and you would have the appreciation, you'd have the cash flow. The rents were increasing at a dramatic rate. And the market was such that you were getting equity appreciation as well. So you're growing the actual wealth that was being created in those projects was happening. We're now in a shift where the IRR, the returns on those same types of properties are being compressed a bit. And that's because the rent growth is not as hyperbolic as it has been, because the rent's not skyrocketing at double-digit year-over-year percentage increases. We are actually getting back to a more stabilized market, I guess, right, on the multifamily front. And so that means that the IRR, which is the internal rate of return that some investors are sensitive to, meaning I need a certain return profile on these properties for me to put my dollars into this investment, those have come down in recent times. Let me, I guess, set the stage and we'll talk about what IRR is. Okay, it's the percentage rate earned on each dollar that's invested over a period of time that it's invested. You can look at if you put your dollars in day one and you don't put any more dollars in and you don't get any cash flow for 5 years, what is that IRR going to look like? And so what I want to talk about today is an IRR sensitive investor compared to a non-IRR sensitive investor, and kind of what the drivers are behind the two different types of assets that you can acquire, depending on the type of investor you are or the type of operator that you are. And again, this all comes from the deals that I'm looking at. And I really want to find really good real estate that is very stable and secure and has the cash flow there. And even though the returns may be a little bit lower on an IRR basis, the properties are solid properties. They're fantastic properties because you have a less chance of losing if you buy a really good piece of property. Location, and property itself, all of those good things. So again, that's the rationale behind this episode. So just to discuss, right, there are some investors, and you may be one of them. If you were to put your dollars to work, you want a pretty high IRR on your return. And so that to me is a priority over high return compared to stability in a property. So to me, if you're going for a higher IRR, you're going for a higher risk property, okay? Higher risk projects. Even though they have the potential for higher returns, they also have the higher potential for risk. So there's nothing wrong with it. Obviously, it just depends on what your strategy is and what your personal goals are. So it's kind of a risk reward sort of deal. Higher IRR often implies that there is a higher risk. And so to give you an example of a higher IRR property, it might be something like a fix and flip. So in a residential arena, your IRR goes through the roof when you look at it and say, I bought this property, I rehabbed it, and I sold it, and it took me 2 months to get through that whole process. Compared to rental property, where you buy it, you're going to sit on it for years, and then you're going to realize some kind of gain down in the future. Your IRR is going to be compressed because you're putting cash in on the rehab, and you're getting it out very quickly, and you're getting a big bump. And so your IRR is going to look pretty good. On a multifamily front, it could be a development project. Again, you're going in, you're putting money in, you're not going to get any cash flows for the first year or two while you're getting that property stabilized. Whoever the operator is may sell that property in 2 years, and there's going to be a big IRR on that. It's a little riskier because you're not getting any cash flows along the way, and the economy can change dramatically over a 2-year period from the day that you put that investment into that project to the day it's actually stabilized. So there's just a risk associated with buying a non-stabilized property, not fully rented out. We're proud to be sponsored by Ridgeline Investment Group. Ridgeline has a track record of transacting more than $53 million in assets throughout Texas. Ridgeline is currently looking to acquire 100 to 200 unit Class B multifamily communities between 5 and 20 million in San Antonio, Temple, Waco, Tyler, and other Texas secondary markets. To learn more about Ridgeline Investment Group, visit www.ridgelineig.com. And so, again, it's just important to know the risk-reward profile with chasing higher IRR returns, okay? The other side of it, I kind of alluded to this, is that if you're chasing the higher IRR, you're usually short-term focused. You're looking for a quick pop. You want to be in and out of that investment, and that'll juice your IRR, your return. So the difference is, in a non-IRR-driven investor, there's usually a priority over preservation of capital and stability compared to just getting a return. Like, all I focus on is a return. I need this massive 36% return compared to an IRR that is lower, maybe 10, 11, something like that. But it's stable. You're buying a certain type of asset that is going to be tried and true. It's already stabilized, and you are just putting your money to work, and you're getting that return on a consistent basis, and you don't have to really think about it. So again, non-IRR driven, maybe more interested in consistent cash flow. And like I said, long-term preservation of capital. So stability. So when you are looking at these types of properties, it might be a B plus on the multifamily side. If you don't know the different classes of property, D is like a very rough property, needs a lot of capital improvements. A C, kind of mid-tier, may need a lot of capital improvements, but depending on where it is, the rents are there, workforce housing, that sort of thing. B, and then an A. So A is like the super nice, brand new, all the greatest amenities and all of that. So we focus a lot on the B and C plus, just because there's value add that we can force some appreciation, but we keep them and the rents go up, all of that. So again, those are the types of properties that I want to focus on and look at. And a non-IRR driven type of purchase would be looking at something instead of like a 3 to 5 year time horizon on the investment. You're buying these, and this is me personally, like I want to buy property and hold them for the long term. I'm growing wealth. I'm investing in these deals, and I want my kids to benefit from these properties that we're buying. I want to be able to 1031, all these things to keep growing the cash flow over time. So I'm okay with a lower return today, just knowing that down the line, it will pay off dividends because, one, I'm preserving my capital. So anyway, the types of deals that I am looking for and looking at are C plus and B properties that are in great locations that were built after the 1980s so that they have pitched roofs, they have central heat and air, they have the right kind of wiring. And I know that the actual product itself, the building, the physical building, will last longer and have fewer issues than buying a Class D property. Not to say I wouldn't buy those, but again, that's a very specific type of property that I would buy. For the long-term game that I'm wanting to play, it is non-IRR driven, quality assets, quality properties, long-term preservation of capital. So again, that's one of the differences. If you're IRR driven, then you are short-term focused. When you are non-IRR driven, you're value driven and you're long-term driven, right? So consistent, predictable returns over time with less risk. That's really what we're looking for. I've kind of talked about this a little bit, about my strategy, obviously, throughout this process, but just to really hit it home, coming from the single family world and doing a lot of fix and flip, doing a lot of wholesales, and really being a high transaction volume business for the last 10 years or so, I have completely shifted focus. I want to spend all of my time looking for long-term value-driven properties that will produce consistent, stable cash flows for a long time to come. And so that's really what I'm targeting and looking for. It's not necessarily an IRR driven. Do we take that into account? 100%. Yes. I want to know what the IRR is. I want to be able to talk to potential investors about what that IRR is and all the other value driven metrics that we look at, like AAR, average annual return, IRR, and there are a number of other ones. So cash on cash, all these things. We look at all of those, but in general, the strategy is preservation of capital, investing in solid properties that are going to last, that will continue to be sought after by tenants in great locations that we are very comfortable that the employer base is going to remain. The values will slowly increase over time. We're not getting crazy with our underwriting and saying that these properties are going to hockey stick up in value like they had in the last few years. And so, again, that's really what I'm looking for. Just wrap it up with this. It's really important that you understand the operator that you're working with and then the types of properties that they're going after, and just understanding the different types of return profiles for properties. the higher IRR that you have on a given deal, it looks great on paper, but it doesn't necessarily mean that it carries the same amount of risk as another project. So just keep that in mind when you're looking at offerings that are coming out, and really know, again, this goes back to early episodes, know what your goals are for your investing. If you're trying to build your actual cash in the bank, then going for a higher IRR is great. Going for short-term deals that are going to grow your actual capital in a shorter period of time, that's great. And so we offer some of those. There are some strategies that we implement. Like I said, I wouldn't mind. Just yesterday was looking at, it was probably a C- property. Needed a ton of work and needed a big CapEx budget attributed to that property in order to get it back online. But it was in a great area. I like the historic nature of the whole neighborhood, historic tax credits that we could get from the city, and then a renovation, kicker as well. And so I look at those things and I know that I can be in and out of that deal. But my exit personally would probably be to refinance that property, return as much capital to investors as I could, but maintain the property and keep it for the long term. Again, just getting it to that position of it being a great property and great location, moving it from probably a C to a C+ and that sort of thing. So just know the types of investments and the types of return profiles when you're looking at these deals, and you'll do great. So if this information is helpful and you're getting value out of the show, I hope you are. Go on, please, if you would, and rate and review the show. And it helps us out big time. If you have specific content that you're interested in hearing or having me cover, by all means, reach out to me. My info is in the show notes down below, and I would love to chat with you and get to know you better. All right. Catch you on the next episode.
Surprisingly, most of the agents we speak with got into real estate hoping to gain passive income and become work optional. However, only 1 in 5 ever start investing. Most are simply too afraid to start. Once you get educated by listening to this show, you'll be able to overcome that fear and become the 1 in 5 who are finding financial freedom. Don't miss a single episode. If you want to stay up to date, the best way is to make sure you're subscribed. So if you haven't done that, go ahead and do it now. And we'll catch you on the next episode.